Mohit, let's move on to the next question. I think that is around valuation, and we'll take that up.
So is it necessary to calculate the valuation of a company?
Okay, so I think just before I take this question, so Tanay is asking, but I think Shreya has a point here. She can take it from abroad in form of ECB. Yeah, so there are, I think, Tanay, there are ECB rules and regulations, but I think those are not simple, and I think we are not going to take on this session at least. If somebody wants to understand how the ECB work, and then I would then say, if you are actually interested to borrow the money from abroad, I think convertible notes is something which you should explore, and we'll discuss in this session as well in the further question. Because a convertible note is something which is like a formalized ECB for DIPP registered startups and all that. So I'll explain in further question. So for now, let's take up and guys, yes, do ask more and more questions. I think we're very much interested to understand what you think. So let's move on to the valuation part. Most important in this entire webinar, I would say. So first question in anybody's, I think, mind, and somebody has even asked in the chat box that, is it necessary to calculate the valuation of the company? How do I value the company? Somebody even asked if I can give ESOP on the monetary terms. That can only be possible if you do the valuation of your company, right? So all questions around valuation, and the follow-on question is that how do I value my startup? I think this is the most puzzling question I have seen from everyone. Until unless a startup raises a seed fund, till that time they're just puzzling around what should be the valuation of the company. They talk to tons of people, but I think no clarity at all. So let me just try and give you the clarity in next 10 minutes. So first of all, first question first, is it necessary to calculate the valuation of a company? I would say 95% yes. Okay. There are non-valuation rounds as well, and but those rounds are not very much explored even by investor at the seed stage. There are a couple of investors who are coming up in the market now. They say they do a non-valuation round, which actually means that you need not to determine the valuation now when you're getting the seed round. You need to get the valuation at the next step when you get the next round of funding. So it just postponed the I would say the valuation exercise, but it does not. But valuation has to be done, obviously, either today or tomorrow. Even doing valuation today at the time of seed funding, I think 95% of the cases, whether it's an angel investor, whether it's a first check investor, or institutional investor, or a venture capitalist, they do ask for the valuation, and you need to negotiate valuation with them, right? So 95% of the cases, yes, you need to have the valuation. Now, how do you calculate the valuation? That's the most important question. So, and is the DCF method, because some people must have sort of heard of this DCF method, discounted cash flow, right? Is there in something else as well in terms of valuation, as far as valuation is concerned? So Mohit, can you move on to the next slide?
Yes.
Mohit, yeah. So I think in early stage, using discounted cash flow or any method like that would actually require a lot of assumptions, a lot of estimations, and a lot of I would say foresightedness in terms of what you're going to do, how you're going to do. And I'll tell you why it is not possible. See, from a business standpoint, at the seed stage, even you aren't very sure what is your product market fit. Neither the investor. They're just putting in the money, whatever your hypothesis is with respect to the product market fit. And if you're not very sure how your product is going to play out in the market, you will not be very sure how you will be monetizing that product, right? Whether it's a SaaS product or a B2C company or a B2B company, whatever company it is, or a consumer brand. So once you do not have your revenue model set up, and once you do not have how you are going to expand this concept, which in turn require you to incur a lot of expenses as well. So it is very impractical to use the discounted cash flow, right? Even investors do not push you for discounted cash flow in the seed round. It do happen in Series A, Series B, and so on, because by that time you must have identified your revenue model, your expenses, how you're going to expand, how you're going to penetrate, your cost structures, and all that stuff. But in seed round, it is unlikely that you get a valuation on a discounted cash flow. So what else to do? Now there is a method called a scorecard method But does it give you the valuation? I will say no, it does not give you the figure. We'll come to that, but let's understand this first. So scorecard essentially tells you what your valuation consists of. For people who are just entrepreneur who want to come into the startup journey now, I think very important to understand different aspects of their startup. They should not be too much excited about their own experience or their knowledge about the technology or their understanding of the market, right? Because it's a combination of all these factors which actually play out to build a successful startup. Number one is the management team. I think seed rounds are getting, it's kind of a bet which investors are taking on founders. So the management team, the founder team and the core team, has the highest percentage. It is like 25 to 35%. You have to make sure you have a very good management team before you go to fundraising. If you do not have a good management team, if you're a solopreneur just trying out yourself and you cannot, put forth any of your core team employees to investors, I think it's very hard for you to raise money. You have to even train your employees to go and face investor along with you if you do not have a co-founder. And that's how investor will feel more trust, and that's where it comes first in the priority. Second is the market opportunity. Obviously, if market opportunity is not big enough, if you are just opening up a grocery store or a dairy or a bakery or something of the, or maybe some organic product or anything of that sort, if market opportunity has to be very large and you should be very cognizant of that market opportunity, then only I think investor will come on board with you. So market opportunity, theoretically we say in the VC, if you want to get a venture capitalist funding, at least you should have a market of $1 billion. $1 billion means approximately 7,000 crores. So it's not a small number. You have to just figure out what your market size is, right? Unless it could be a good cash flow business, but it would not be considered by venture capitalists. Third is level of competition. I think competition do matter, but does not matter to a larger extent because every startup has their unique proposition. But it makes a difference whether you are going into the crowded market versus you're going into a market which is not yet very much explored, and you're, some of the early ones like agricultural startup market is something which is now coming up. So level of competition there is very low, right? But something like payment is already flooded. E-commerce is already flooded. Mobility is already flooded, right? If you're going in that kind of a segment, you need to come up with really, good proposition. Implementation plan, it says 5 to 15%, but I will rather allocate maybe even a more percentage because idea is worth nothing until it is implemented. So you need to have a strong implementation plan, how you want to play out, at least your initial clients, traction, customers, B2B, B2C, whatever you're doing. You just need to make sure that you have a good, at least understanding of the market and how you're going to penetrate the market. You should have that kind of a plan. And then funding required. So obviously, is it like, you require funding, that's why you're, going out to the VC, but then those funding required has to come out very meticulously. You cannot just go loosely and say, I need, $1 million. That's not going to work. You have to say why you need $1 million. Why not, $500,000 or why not $250,000? You need to do your homework really well before you even go put up any amount, because it might sound fancy to raise larger amounts, but it is not that easy. There's a lot of meticulous thinking involved behind this. You need to convince actual investor why you need money. They'll say just execute it and show us some results without having money, and then are happy to come at a later stage, right? So these are the 5 factors which normally are considered in the valuation of startup. Now, Mohit, can you jump to the next slide? Okay, next slide, next one. Yeah. So now you will say, Karan, we got all that. We also heard that from someone, but what should be my valuation of the company? So let me give you an indicative, things, how you should think about the valuation at least. So for a seed round company, this is my own hypothesis, working with almost 30 plus companies on a fundraising perspective. This is my own hypothesis, how it works. If you're a B2B company and if you're a pre-revenue, then do not expect any funding. So as simple as that, right? So any concept which is meant for a SaaS company, which is a B2B company, or an e-commerce site like a Udan or an industry buying kind of a site, or Ninja Cart, which are a B2B kind of focus, but you are pre-revenue, you're not earning anything now. Do not expect any funding, because in B2B you have to showcase that you can actually get the client paid for your product or services, right? So you have to at least start earning something before you even go for funding. Then second category is B2B post revenue and B2C pre-revenue, but with some traction. Like people are downloading your app, your technology, and all that stuff, right? Then you can say, okay, then you can reasonably say at the seed round, do not talk about millions, it's fancy to talk, but realistic number in 85 to 90% of the cases will be, just think of a valuation between 3 crores to 10 crores. Do not overshoot or do not overvalue your potential and everything else, because as of now, you're just trying out, how the thing's going to work out. Irrespective of how sure you are about your idea, do not just be overconfident, I would say. Just be cautious about the unknown factors which might play out and which can actually screw up your game. So just think of a figure between 3 crores to 10 crores if you are a B2B post revenue or B2C pre-revenue and with some kind of a traction. Now comes the third level, I would say. If you are a B2B company post revenue and revenue is more than 50 lakhs, there are a couple of companies in HR technology, agri technology who start monetizing it from the day one, because once you start doing a B2B kind of a marketplace, you start keeping your own margins, and then doing some kind of a turnover is not that difficult if you're able to connect some deals. So if you are a B2B company and a post revenue company and your revenue is more than 50 lakhs a year, I'm not saying a month or a quarter, it's a year, right? Then you can think of a valuation between 10 crore to 15 crore. But unless you reach that kind of a benchmark, if you're a B2B startup, post revenue less than 50 lakhs, do not think about valuation more than 10 crores. But if you cross this hurdle of 50 lakhs as a ARR, I would say, annual recurring revenue, I think in that case, you can think of a valuation of 10 crores to 15 crores. I think this is the reality. As in today's date, you will say, Karan, we have seen a couple of rounds which have been done on different valuation. I will not say those have not been done, but I'm saying 85 to 90% of the cases, this is the figures which are being used. As well as now the valuation has become more tricky and investors are more and more cautious about giving higher valuation to the company. They do want to see traction before they actually commit any capital, and valuations are not as rich as they would have been earlier, and thanks to Corona, because it has just screwed up a bit the business ecosystem. So valuation are now hard to get. And minimum valuation at a seed stage, I will say, do not expect, okay, if your calculation says you will raise, for example, say 1 crore for 5%, forget it. No seed investor will come in your company below 10%. I know there are a couple of incubators and all that stuff who do it at 24/7 model, which I'll talk about in last question. But a reasonable thing, I think, for investor to get incentivized to come into the company, and even for startups to raise money, you have to dilute 10% to 20% of your company at the seed stage. Less than 10%, to me, it does not make sense if I would have been an investor. More than 20% is too much to give, right? So you should think in this range of 10 to 25%, right? So I'm sure, that with this kind of a data set, we are sorted with 80 to 85% of the use cases. But if you think you have a special use case, you can reach out to us. We are more than happy to, look at that on a case-to-case basis and think if you actually deserve a different kind of evaluation other than this. But these are kind of an indication which I want to throw up, right? So Mohit, can you go just the next slide?
Yes.
Yeah. So guys, I think this is again one more important slide. We are, I think, overshooting on the time. It's just a few minutes to go, but let's carry on and let's see even if we can stretch this for 15 more minutes. I'm sure you must all you all must be enjoying it as I am doing, right? And do ask more and more questions. So yes, now second question which people ask me is, Karan, should I take my GMV or my revenue for valuation? I have heard Amazon do this kind of a GMV. They got multiples. They are e-commerce platform. Company like Uber, company like Zomato, they got valued on this GMV. And then are they my revenues first of all, right? Or if they are not my revenues, then what is my revenue? So what should I do actually? And a lot of people have this question. So guys, first question to ask is, number one, is your GMV your revenue driver? What does that mean? So that means if you are an e-commerce platform or a platform like Uber or a platform like Zomato, right? A marketplace model or a connecting model, B2B model, B2C model, then you have to think, right? Is the GMV driving your value? For example, take an example of Magic Bricks. Okay, so, or take an example of Naukri.com, right? So Naukri.com, companies list job there, employees get the job. Is it like, so whatever salary an employee gets, it's like a GMV for them, right? But does it actually means anything to them, to their revenues? No, because they sell subscription plans. Magic Bricks just sells the subscription plan, nothing else, right? What LinkedIn do? Is there any GMV relevant in LinkedIn? Not at all. Is there any GMV relevant to, I don't know, like companies like Chaos? No, not at all. It is like their consumer brands. GMV is not, is not something, meaningful to them. So first of all, you have to think, is GMV your revenue driver? Even if you're a marketplace, but if your model is subscription model, you allow clients, supplier, and the consumer to come on your platform and subscribe to a plan and then have unlimited access, right? So you cannot, benchmark your GMV for the valuation, because the GMV does not get you anything in your P&L account, right? But if it is the case, for example, say Zomato, Amazon, Udaan, Big Basket, I've named those companies, right? Policy Bazaar. So let's compare two companies, Policy Bazaar versus Ecno. So Policy Bazaar is a platform, right? It facilitates the insurance selling. So you can say whatever insurance is getting sold, they are earning commission on it. So the revenues are directly impacted by their GMV. So you can take GMV on account for calculation, for the valuation calculation, and then you can apply multiples on GMV. But make sure that your margins are not less than 15 to 20%. That is my next point. If your margins in your GMV is less than 15 to 20%, forget that anybody will take your GMV as a base for valuation, because even if you're increasing your GMV, that does not mean anything to your business, right? In insurance, Policy Bazaar, company like Policy Bazaar, they have handsome margin on insurance. So they can take GMV as their, basis for their valuation. Now I'm talking about seed stage. Let's forget about now what Policy Bazaar is. They're a larger company, they have more valuation basis, but what I'm talking about the seed stage, right? As compared to the company like ACKO. So what they do, they sell insurance, they're the insurance writer. For them, GMV does not make sense because they write the insurance, they sell the insurance by themselves, right? And whatever they sell in the insurance, it's their money. And whatever they spend to underwrite that risk, it's their expense. So that's the different business model. They're coming up with an insurance brand as such. For them, GMV is not relevant, right? But two points I think to consider, to take away is your GMV a revenue driver? And is your margins on GMV is like 15 to 20%? If you qualify these two litmus tests, I think GMV is something which you can think of to calculate your valuation multiple, right? So that is from my side. Now we have 2-3 questions. Sir, can we get a copy of this session for learning purpose? Why not? I'll share that across. Then another person says, how is the GMV computed current? Okay, GMV is like the gross merchandise value. It is like for Amazon. If a person, if you place an order in Amazon for say for a chair, so a chair costs 1,000 rupees. So it goes to Amazon nodal account, and then it goes to the supplier. For example, say they cut 20% tentatively, and then they give rest to the supplier. So that becomes their GMV. Like they say that through Amazon we have facilitated a sale of 1,000 rupees. In that 1,000 rupees, their cut is just 200 rupees. But they say we are enabling a transaction of 1,000 rupees, right? And they say this should be the basis to calculate my valuation. And this has been the accepted criteria for venture capitalist investment. That's not. It is not that they do not accept such kind of a basis. They do. Investors do accept. But just make sure that your margin for the GMV is good enough. If it is not good enough now, just make sure you have that kind of a plan, right? That maybe you are just penetrating the market now, not charging anything. But later on, you should come with something with your revenue model, which is linked to the GMV, not the subscription plans. If you're selling the subscription plan to come supplier and consumer on board on your site, then GMV is not relevant for you. It is the value you earn from the subscription plans, right? For example, what Magic Brick do, they sell the subscription plan to the real estate developer and the brokers, right? Those kind of a thing. And even what Naukri.com do, right? Even if what LinkedIn do. LinkedIn give you a premium kind of a subscription, but there is no transaction happen on LinkedIn, right? So I think this is, we have covered this enough. And guys, we are almost like 3 minutes remaining. I know, but I would like to extend this, session by 15 more minutes. I think whomsoever could just spare those 15 more minutes, more than welcome. And if whomsoever some compulsion, I think they can leave. That's okay. So I think people are asking how are companies like OLX valued? Oh, wonderful question. So OLX is like a marketplace. Now we need to know, dig down and see what. So OLX is nothing. I would say it's like Amazon for the second-hand goods, right? As far as my understanding of OLX is concerned, it's like second-hand or refurbished items are getting sold there. If they're keeping a margin for, say, I would say 15-20%, I think their GMV is good enough to take as a valuation criteria. And even if what Cars24 is doing, they're also selling cars, right? Buying cars and selling cars. What Cashify is doing, I think this Cashify is the company who sells and purchase and sell the second-hand mobile phones. If they're keeping a margin of 15-20%, I think GMV is the right parameter for them to get the valuation back.